remembered someone telling them at some point, treat the janitor the same way you treat the CEO. And the thought process there is there's a morality factor, right? Do the right thing, just be a good person. But the other side is you just never know where that janitor is going to end up.
Welcome, everyone, to our Hero Capital show. I'm your host, Tim Mai, and today I have an amazing syndicator, Mr. Tyler Chesser, on the line with us. Tyler is the co-founder and managing partner of CF Capital, and CF Capital is a private equity real estate investment firm with a focus on acquiring and managing high-quality multifamily assets. Since founding CF Capital, Tyler has played a pivotal role in growing its portfolio to over 1,500 units across Midwest and Southeast, with a total valuation exceeding $200 million. Tyler is a seasoned speaker and educator. He has shared his expertise on stages across the country, including Best Ever Real Estate Investing Conference, which is coming up here next week, Blockchain Real Estate Summit, and North Star Real Estate Conference, among many others, and where he shares his insights on multifamily investment strategies, capital raising, investor management, asset management, and leadership, have him be a trusted voice in the industry. Tyler has a prestigious CCIM designation, as well as Urban Land Institute, and is also a regular educator at the National Multifamily Housing Council as well. And and personally, he has raised over $65 million in building out all of this portfolio. And so with that, let's give Tyler a big Texas welcome, y'all. Woohoo!
Thank you, Tim.
Hey.
It's always a pleasure to be with you, and it's always a little bit weird when somebody's reading your bio, but I appreciate the introduction, my friend.
Yeah, definitely. Very impressive bio. Thank you so much for being on our show today. Let's start out with a little share, if you can share with all of us a little bit about your background and how did you get into this world of multifamily real estate?
So in 2013, I made the transition from being a corporate employee to getting into real estate. My first introduction into real estate was as a sales associate, real estate agent. I then transitioned my early real estate career into commercial real estate sales, and ultimately that kind of culminated in founding and creating a commercial real estate brokerage company where I was really focusing on income producing real estate, but my niche was in multifamily, and I became known as the apartment guy over the years, and that just compounded through a business by referral. And I actually started investing in real estate as I was really passionate about personal development, investing in myself. And this guy called Robert Kiyosaki wrote a book called Rich Dad, Poor Dad, opened my eyes. I'm selling these assets that wealthy individuals and wealthy families have been using for thousands of years to generate wealth and create options and opportunities in their life. And I started investing in multifamily real estate in 2016. And I was really just doing that on my own, kind of smaller deals. First deal I ever did was an 8-unit property. Then I went larger and I did a 36-unit property and started investing as an LP in larger properties across the country with some of my clients and people that I met. And ultimately that kind of transitioned my focus into, instead of being a full-time broker, into being a principal. And that's when we founded, my partner and I, we met through the CCIM Institute. And we created our company, CF Capital, which officially launched in January 2020, but that was in the works for a year or so prior to that. So that's in a nutshell, my background in real estate.
Very cool. Yeah. 2020, it's only been 5 years, not even, about when you guys already have grown it to $200 million worth of assets. That's an amazing growth. I'm curious. I know you started out as a broker. If you were to do it all over again, would you still start out as a broker? For the people that are new on this call, and I actually had this thought before, I wonder if I should start there instead of starting out as a syndicator. What are your thoughts on that?
It's interesting. I learned a lot by just observing my clients and interacting in the market, collecting data, whether it was conscious or unconscious, and just the repetition of transactions and really understanding where the market was, where the market was moving. And I don't think I would change much of my background because of that, because I was able to learn just from doing because the upside is much more significant on the investment side, but the downside is also much more significant, as we all know. As a broker, once you close the deal, you move on. Of course, great brokers are building long-term relationships. They're continuing to add value, whether or not you're transacting. They're focused on transformational relationships and not just transactional. But when you walk away from that closing table as a broker, like, you collect your commission, and it doesn't really matter whether or not the business plan is implemented or the investment is successful. And I think that there's a lot of experience that I gained as a result of kind of that beginning track record as a broker. So I don't think I would change it, but I think everybody's different. Everybody's capacity, skill set obviously may differ from mine, but I really thrived in building my brand, building my reach, and building relationships throughout the early time period. But I don't think I would change my background.
I see. Okay. You mentioned transformational relationships versus transactional relationship. Can you expand on that and share with us a bit about what you mean?
Yeah, absolutely. So transactional relationship is, hey, what can I get out of this discussion? Like, for Tim, like, for example, if I was transactional, I would say, hey, Tim, who's going to show up to this talk today? Who's going to listen to it? And how can I convert them into my funnel immediately so that they can become my next investor, or we can do a deal together and we can create some sort of transaction, right? And we're only focused on that. And I think that in that sense, you're playing kind of the short game. The long game of transformational is truly understanding who it is that you're potentially building a relationship with, and truly understanding what their goals, aspirations, objectives are, what their pain points are, but really getting to know them as a person and focusing on how can I add value to this other person, rather than how can I derive value from this person. And I just think it's such a different way of approaching relationships. And if I were to simplify it and just summarize, it's long-term focus versus short-term focus. And that's one of the things that I've really tried to lean into throughout my career, is just playing the long game, being patient, being open-minded to opportunities, of course, creating transactions when there is mutual benefit, but really thinking about, how does this really benefit each of us in the long run? And does that compound? And if not, like, having a recognition that, hey, I can be detached from this as well if for some reason this is not serving everyone's long-term best interest. That's how I see the difference in transactional versus transformational.
Yeah, that's really good. I come from the single family home world. And in that world, the transactions are a lot smaller. So it's more common, especially when we're dealing with sellers or sometimes even buyers. It is a very transactional. The chance of you doing business with a seller again or a buyer again in that space is slim, right? And so even the real estate agents, like, even their relationship with a normal homeowner, a normal home buyer, is more transactional as well. But yeah, here in the syndication space, where our deal size are a lot bigger, plus we don't just do one deal in our lifetime, we do many deals. And so the need to build transformational relationships, long-term relationships, just becomes so much more important, and it's almost like a must. You really don't have a way around it, right? So even if you were not transformational before, even if you come from another industry where it's a low ticket sales, where you're used to transactional, coming to this industry, you kind of have to force yourself to learn to make it about long-term relationships. Yeah, so that's really good, Tyler.
If I could just add one thing,
Yeah.
to a certain degree, this is almost enlightened self-interest, because think about it from this vantage point. And I think everybody on the call, everybody listening, has probably remembered someone telling them at some point, treat the janitor the same way you treat the CEO. And the thought process there is there's a morality factor, right? Do the right thing, just be a good person. But the other side is, you just never know where that janitor is going to end up. For example, like, one of the first deals I did in commercial real estate early on in my practice was I did a 1,500 square foot lease for an office. And I didn't really do much leasing. Most of the stuff I did was sales, and they weren't huge deals, but they weren't small deals. And this was really probably not worth my time. But thinking back to it, this individual turned out to be someone who I did many deals with thereafter. He grew as an investor, and he actually invested many hundreds of thousands of dollars later in my syndication deals. And so I never would have expected that would have happened. But I think it's enlightened self-interest to focus on everybody, as there's a possibility here. And like, you could almost boil it down to say there's an enlightened self-interest to where, yes, you're doing the right thing, but also you never know who anybody who's going to turn out to be.
That's so true. So good. It's great example of the importance of playing the long-term game. Let's talk about partnership. I know that in these deals, it's common that we will partner with others on a specific deal. We'll co-GP with them. But in your case, you're starting this business with an actual business partner. Walk us through, what have you decided that you want to take on an actual business partner and not just a deal partner? Yeah.
I'm very thankful that I started from day one with a partner, because I cannot imagine like the weight of responsibility all falling on my shoulders, whether it's developing the team, overseeing the systems of the team, overseeing operations when it comes to asset management, capital expenditure programs, acquisitions, equity raising, legal management. The list goes on and on. For any business, this is certainly the case. And I admire founders who can come out of the ground and just really handle all of those responsibilities. But I think that there's a lot of value in partnership, especially from day one, and being able to shoulder responsibilities, even make decisions. At the end of the day, sometimes having a sounding board to make tough decisions, or even day-to-day decisions that can have a variety of pros and cons, can be extremely valuable. So like for me, like I know we've had this conversation quite frequently over the past even like year, is, man, I'm so glad that we have each other as partners to be able to lean on each other and like just leverage each other. And I just think that there's such more of an exponential growth pattern if you can find the right partner. And it really does come down to complementary skill sets. And if you're all doing the same thing, or if you're just really doing the same sort of activities and have a similar skill set, then it may not be ideal. But if you have the same sort of common values, North Star, but complementary skills and different roles and responsibilities that are clear, it can be super valuable. So that's my thought process on partners.
I see. Okay, very good. And what role do you play versus what role does your partner play in the business?
Yeah, so we are both visionaries and integrators. So from a high level, like business ownership perspective, we play a little bit of a dynamic subordination in terms of when the moment calls for visionary expertise or integration. But when it comes to actual real estate application, I focus on equity and strategic partnerships and marketing of the firm. And my partner focuses on asset management, acquisitions, and kind of deal flow and so forth. So there's a little bit of kind of a role and responsibility difference, but we both do play part in each of those functions.
It makes a lot of sense. Yeah, that's a very common setup. I mentioned Paul Hutchison earlier. Same thing with him and John Pennington. John Pennington handles all of the operations, the acquisition, the asset management stuff. And then Paul was out there handling all of the capital raising, whether it's equity, debt. And yeah, so that seems to be a really good like dynamics of a partnership in our business for sure. That's really good. And then, yeah, so what have you guys, out of all the different asset class you can choose, what had you choose multifamily?
Multifamily was really the asset class that we had the most experience in, and we understood it to the highest degree. We do have a vision to where at some point we will expand sort of our asset classes, one of which we're looking at closely for the next few years, really more than anything, is industrial. But multifamily is really the kind of asset class that we have the most relationships in, we have the most expertise in, we understand the nuances so that we can protect investor capital, and we have experience and we have a successful track record within multifamily. But ultimately, it is also an asset class that I'm sure many of the listeners and folks that have attended the party today would agree is that you can understand sort of the risk profile when it comes to, look, at the end of the day, our philosophy as human beings, we need three things. We need food, we need water, and we need shelter. And multifamily real estate provides shelter. And ultimately, yes, there are risk factors in the marketplace that I think we're all interacting with today, more importantly than we have perhaps in the last few years, that really help us really understand even further the ups and the downs of this asset class. But ultimately, shelter is always going to be in demand. So you have to think about that in terms of like how that compares to like office real estate, for example. Office is obviously going through a transformation. And so we just understand the dynamics of the asset class, and we're experts in the asset class, and we're staying in our lane until we have the capacity, breadth, and partnerships to be able to expand outside of the asset class as well.
I see. And then why Midwest and Southeast? I'm curious about that because it's two somewhat different markets.
Yeah, no doubt. And to be specific, we are focused on Kentucky, Indiana, Tennessee, and Ohio.
Okay.
And so we're based in Louisville, Kentucky, so right in the middle of all of our markets. So we're very hands-on when it comes to our investments. We have a significant relationship base within our markets, but also our markets are somewhat counter-cyclical over the last couple of years. Indianapolis, Louisville, Kentucky, Columbus, Ohio have been markets that have been top performing markets in the country in terms of rent growth. And they haven't been as crazy of like population growth and job growth in comparison to some other Sunbelt markets. But I think the pricing makes a lot more sense, and you're not having the level of new supply in these markets, which is continuing to put upward pressure on rental rates and so forth. But we are still seeing continued progression. So we're seeing like a slow and steady sort of marketplace in our markets for the most part. A lot of stability in comparison to some other markets where you may see more boom or bust, but that's where we're focused on. And we're very long-term focused in how we're doing this. We're not looking to play the speculative game. And for the most part, our markets are not speculative. You're looking at positive leverage. You're looking at replacement cost, acquiring assets below replacement costs and so forth. So that's really the focus on our markets. And when I say Southeast, it depends on how you look at it. Kentucky in some places is Southeast, in other places is Midwest. Nashville, Tennessee obviously is a little bit of an outlier in some of the ways that I described the components of some of the other markets that we're focused on. But anyway, that's some of the thought process behind our markets.
A lot of operators get deals that have challenges with, especially deals that they acquire in 2021 and 2022. How have you been navigating since the interest rate hike started? And do you have deals that have been challenging for you?
Yeah, I think the last couple of years have been certainly challenging for most investors in the market. And if you made any investments, to your point, in 21 or 22, and depending on the way that you finance those deals, you're probably running into some covenants that are needing to be discussed or worked out with your lender, and or you've got issues that need to be addressed. Fortunately, we've been very patient throughout the past few years, and we have recognized the level of, how do I describe this, irrational exuberance that was being exhibited across the marketplace, especially in 20 and 21, and really the first half of 22. So we were very patient. And frankly, if I would have looked back today to day one in 2020 and said that we have grown to the rate that we have, I would have been surprised, to be honest with you. I would have thought that we would have grown faster. But I'm proud of the fact that we've been very prudent, and we've been focused on deals that have made sense, deals that are acquired well below replacement costs, even after value add and so forth. All of our deals are doing well, but that we've definitely run into issues from like inflation, for example. Payroll has been a big issue that has impacted NOI. Insurance has impacted NOI. Tax rates have gone up. I think everybody is probably dealing with these issues. And of course, interest rates are a big deal. So when you're resetting debt on deals that you acquired 3 years ago, you've got changes that need to be made. So we have a deal right now that we're going through a refinance on that we would have expected to sell this year, that we acquired in 21, but we're looking to do a HUD refinance. So it's a much longer term hold as a result of the change in the capital markets. And that refinance is obviously setting out the hold period much more significantly. But those are a few things that we've been working through the past few years. And it certainly has been a challenging operating environment as well. And I think it has heightened the focus to be able to execute on your business plan and not just ride out cap rate compression, which is not something that we would expect to be a normal condition of a long-term investment market. It's probably a good reset for everybody, but certainly has required everybody to double down their focus.
Yep. Yeah, it's pretty impressive that even though as a partnership, you guys only started in 2020, which is like pretty much the height of the market, and you've been able to acquire quite a bit of assets since then, yet was prudent enough to yeah, like selectively only get into deals that made a lot of sense. And so that's really good because a lot of people didn't do that. They got, especially if they started at the height of the market, they were so trigger happy to be able to get into deals, and then now they're in trouble. And yeah, I hear so many, and we all do, I'm sure, like so many deals that's losing all of investors' money and going to foreclosures and stuff like that. And so, give us an insight into your thought process. What, other than just conservative underwriting, anything else that you might have been able to foresee? Hey, we're gonna be in a down market. I'm gonna be more careful than what I would have been, if the market continued to go up. What are some of that thought process went for you guys?
Yeah, that's a good one. Thinking back to 2020 through the first half of 2022, I
Yeah.
think that this is the case across most markets, if not all, but certainly was the case in our region. And I'm sure it was in many of the other markets that listeners are active in. But I think to participate in the market at that time, to be competitive, you almost had to finance your deals from a bridge provider perspective. Otherwise, it was very challenging to finance deals fixed rate debt long term and so forth, just from a proceeds perspective and so on and so forth in terms of just like your projected cash on cash returns and overall returns. But I think if you could foresee the fact that zero interest rates it's not going to be a prolonged period, you would have thought about the market a little bit differently. It's hard to predict. It's hard, if not impossible, to predict where the market is going to go, but to really hedge your bets and say, look, zero interest rates is an anomaly, and it's not going to be something that's going to be around for forever. In fact, it's not going to be around for a long time. So finance your deals, fix them long term. That would be the best approach. And if you're not able to win deals in that capacity, then so be it, and just keep going. Time certainly informs us, and we get wiser through time. But that's probably the biggest shift that I probably would have made, because we've had to work really hard on getting deals to refinance and still pencil in today's market, which has been obviously significantly reset. But that would be my biggest advice to my previous self, if that makes any sense.
Yep, it does. Now let's switch gear and talk a bit about capital raising. Share with us how your very first deal that you raised capital for, how much money were you able to raise? What were the challenges and the lessons that you learned in that very first deal?
I love it. So the first deal we did, it was a year and a half after we put our company together. So another kind of exhibiting like the patience that we exhibited early on with the company. Like that first year, like the half of the year, 2020, like the market was almost shut down because of COVID. Then it turned back on and it was like crazy. And it was like the deals that were getting done, we were like scratching our head is like, how are these deals getting done? And so we kept underwriting deals. We kept putting offers out there, but we kept losing those deals, either getting second, third, fourth, or beyond place on these deals. And so we just kept going. But our first deal was about a year and a half into the company. And it was about a $10 million acquisition, a 247 unit property in Evansville, Indiana. We raised $3 million for the acquisition. This is a 100% value add classic deal. It was built in the late 70s. And the plan was to go in and renovate all of the units and turn that around. So the first raise, I've always thought big. I've always believed in myself. And maybe that's just been by the people I've surrounded myself with, the books that I've read, the podcasts I've listened to, the podcast guests that I've engaged with over the years. But I've always been a believer in my capacity to do things. And so I never really had this feeling of, oh my gosh, we're not going to get to that figure. We went out there and we raised capital and we shared the opportunity with friends, family members, people that we did business with in the past as a broker. And fortunately, we're able to get there. But it was really a classic sense of like, all right, get the word out about the deal, share the opportunity, and really just prospect and follow up. And that's how it worked. And it has been going back to the earlier part of the conversation, just leaning into those relationships, leaning into the long-term relationships. And it wasn't like perfect or anything, but we didn't really run into any major roadblocks to get to that figure.
Yeah. Your acquisition price is relatively small-ish, right? It's not some of these 30, 50, $100 million type of acquisition price. I'm curious as to what's the biggest deal that you've ever raised capital for?
We just did a deal. We just closed 3 months ago. It was a 314 unit property in Indianapolis. It was just shy of a $50 million deal.
There you
And
go.
we
Yeah.
raised 20 million, a little less than 20 million in equity for that deal. And I can say that the capital raising environment in 2024 was vastly different than 2021. It was a great property, a great asset, assumable debt that we were able to assume, 3.4% interest rate, 70% loan to value, very accretive to the deal. It was a challenge, but we did bring in an institution who invested about 65% of the equity that did their second deal with us. And then we raised the remaining balance. But we raised about 7 million in retail LP equity. And it was a grind, man. It was a grind. And I think that there's a lot of skittishness in the market. There's a lot of concern with either current deals or where the market's going and all that kind of stuff. And I totally understand that. But it's that kind of bifurcation where today is a great time to be investing, but it's the hardest time to raise equity.
Yeah. Can you share with us, give us a comparison, the deals that you raised for back when, let's say, prior to 2022 versus the last deals that you raised for, in terms of the number of conversations that you have to raise every $100,000 or whatever that is, or every million? Is it like a 1 to 5, 1 to 10? Like, how much more difficult is it?
Yeah, that is a great question. And I don't exactly have the stat, but my gut says it's 3 times harder. It's three
Okay.
times the conversations. You could push me to say maybe 5 times because it does certainly feel like that at times. And it feels like you've just got to put out 3 times the effort that you did in, call it 2020, 2021.
Yeah. So share with us what helped you. And we're going to also go into the institution side, but just on the retail side, since that very first raise that you did to this last deal, what are some of the things that some of the ways that you've been growing your investor database and growing the relationship that have this be a successful raise for you?
I ran a podcast called Elevate for about 5 years. It was a top 200 business podcast and had a lot of success. I decided to hang up the microphone about a year ago, but that podcast was very successful. I was really wanting to focus specifically on the business, and it was just really starting to take up a lot of my time. But that has continued to compound and actually still bring in investors in our world. But it really has a few things. One thing is we focus on execution, delivering on our promises, and having a great investor experience. And the thought process is a little bit of enlightened self-interest to say, as we do that, we're not only developing long-term and repeat investors, but we're facilitating an opportunity for those folks to provide referrals. So a lot of our investors come through referrals of existing investors that have partnered with us in the past, or they're repeat investors with us. And we have a certain percentage of our investors that have invested more than 7 figures. They've invested in all of our deals. And so obviously we lean into really serving them and providing value for them. But otherwise, we're always trying to get our message out there, speaking at conferences, having opportunities like this to speak with folks like yourself and continue to share our message and give the opportunity for folks to allocate certain percentage of dollars towards our markets and towards our thesis, because we don't really have a ton of other tremendous competitors like in our space. Like we have a blue ocean. A lot of our competitors are focused in your market of Dallas, Texas, or Tampa, or Phoenix. There's a lot of activity going on in those markets for great reason. But our markets aren't necessarily as sexy, but they still have a lot of merit. And getting on stage at conferences like this, podcasts like this, are huge. We've also invested in a significant level of investment in our marketing, just developing our ongoing sort of newsletter and email marketing and social media, and just continuing to get our voice out there has been a huge piece of that. But on the institutional side, it's a little bit different. We're out there having one-to-one conversations, really developing relationships and meeting with folks at conferences like NMHC and out there and really kind of sharing the story of CF Capital and why we're a platform that's institutionally friendly. So it's like beating the pavement on a day-to-day basis. That's really been successful for us to grow our database and network.
Very cool. It's interesting that you've been having your own podcast and you have had success with attracting investors and raising money from your podcast. To see that you have now shut it down. Obviously, you're still speaking on other people's podcasts, but That sounds like a pretty big move. Are you finding more success in speaking on other stages more than, I guess, relatively speaking, to the time that you have to put into your own podcast versus the time that you put into speaking on other people's podcasts and other people's stages? That speaking on other people's stages is more fruitful than having your own podcast?
Not necessarily. It was not as calculated of a decision as it may sound. And Tim, maybe you're going to be my new consultant here to really do the A/B matrix of like, how much value am I getting from doing this versus that? Really, the thought process was, to be honest with you, like I just fell out of love with it. And it just got to be more of it felt like more of a job than something that I was really passionate about. When I started it, CF Capital wasn't even a thing, and it just grew. It was called Elevate, and it was all about mindset, mind expansion, personal development for high performing real estate investors. And I'm still very passionate about those things, but I felt like the conversations just became a little redundant, even though I was speaking with people like Seth Godin and Laird Hamilton and Apollo Ono and some amazing people that were outside of real estate, as well as amazing people in real estate. It just got a little bit redundant. And I felt like when I lost that passion, I was doing my audience a little bit of a disservice by continuing. And so I'm going to probably do another podcast at some point, but I've decided at this time it's focus on the business, the operations, the execution in a time where that's in a premium to be able to deliver for long-term value for our partners. But I do still feel like getting a lot of value from doing things like this. And Tim, better than most, man, this is a lot of work. You got to put all this together. You got to prepare. You got to do a little bit of research. You've done more work than I have today. You deserve all the credit. But anyway, that's a little bit of my thought process.
Right. Yeah, no, it's really good. For anyone starting out, having your own podcast is really good way to be able to learn from the people that you're interviewing while you're building your community. Since a lot of us who starting out, we don't have the expertise to really teach them the content. But yeah, I do notice that once you get more experience, a lot of people will prefer to be able to speak on other podcasts, on other stages, because you're leveraging the hard work and the years of someone building that community, and instantly you're able to tap into that. So there's a lot that goes in that, but it requires you to have the expertise. It requires you to become the market leader that would have people invite you to speak on their stage and on their podcast. And yeah, so I'm putting in my work now. So hopefully in the future that yeah, I'll be speaking on a lot of other stages. But yeah, Neil Bawa is very similar. He's all about speaking, leveraging other people's stages and speaking, instead of having his own podcast too. All right, so let's
Well, I think
talk
you're doing
about
a great job. And I definitely think
Thanks.
I was just going to say, I think there's a lot of value in the notion of other people's networks. And if you can leverage that and continue to add value in that capacity, whether it's on another podcast, at a conference, email list, so on and so forth, I think that can be a great way to exponentially grow your reach. Good stuff.
100%, 100%. I agree with that. I've grown so much in all aspects of the word growth in this business. I've only been in this business now for almost 3 years. April is going to mark my 3 years, and I've grown so much and built a pretty sizable community. And so, yeah, doing these podcasts definitely works really well. Let's talk about when to start engaging institutional players. So here you are, you have this, 15, $16 million raise that you're doing. How did you go about deciding, hey, I want to bring in an institutional player in helping with some of this equity? And then how was it structured as well?
So the first deal we did with an institution was in 2023, late 2023. And it was interesting. I actually literally just got off a call with another fund manager, an individual in a team with a tremendous track record, experience set. And he actually shared with me, he said, hey, is it a limiting belief that we just don't yet have the track record to attract institutional capital? And I said, yes, I think so. But I do think that there has to be a story and a reason why an institution would take a flyer on your group and so forth. And ultimately, what we learned through this pursuit was that to be able to develop a relationship with an institution, and this is a very broad term, right? An institution could mean a variety of things. It could be a private equity fund, it could be a family office, it could be an RIA, it could be a pension fund. The list goes on and on, but those are some of the big buckets. But for us to develop that relationship, it wasn't going to be a, hey, let's go out there and find somebody and then find a deal. It was, let's find a deal and then let's tag this up with the appropriate institution. We actually hired an equity broker to be able to support this endeavor, someone who is very active in this space, in a firm that was very active in this space, to be able to go out and really make a market for us and deliver to us a set of term sheets for a particular acquisition. Now, I can say that this was a lengthy process, and for a normal acquisition, it could be challenging for folks, but this is how it worked for us. And ultimately, once we got over that hump of creating this JV and doing this deal, then you have a little bit of a herd mentality in terms of other institutions to say, oh, if you've done business with them, they've underwritten you as well as your deal and so forth, then we're more likely to take more of a second look at your opportunity. So that's kind of how it worked for us. The structure on that first deal was a soft pref equity stake in the deal, so where they had an overall kind of coupon that they were looking to hit. I think it was a 14%. And the soft piece was, I think they were looking for 3.5% cash on cash or 50% net cash flow. So they invested about 60% of the equity on that deal. So it was accretive to the overall structure, to where that the cash flow could also be shared with other LPs in that deal. So it was a pretty good structure for the opportunity, and it made sense for the business plan and so forth. So it was a 5-year structure, and there are major decision-making rights and so forth, but it's not overwhelming or anything that doesn't make sense. So that was how we approached that first deal. But I do think that's the hardest one, and that's really been the feedback that we've received from folks who are very active in the space, is that if you can get that first one done, it's a little bit of a snowball and can create momentum for future opportunities.
I see. Okay. Now, I know you mentioned that you don't need a whole lot of experience to start attracting the institutional capital, but is there a minimum amount of experience that you're at 200 million now? Is it 100 million AUM is the number? Do you think?
There's no hard and fast rule. I think that our background brought some value for sure. The fact that we have over a decade of experience in real estate, and perhaps our company is at a more infant stage in comparison to some of our peers that they may be looking at, I think that helped. But ultimately, it did come down to kind of story and expertise. And it really was about developing a relationship. And then also, again, it really comes down to the merits of that deal. And if the deal makes sense, as well as the fact of whether or not our company has the capacity to be the lead sponsor and execute and really adhere to the business plan that we collectively create, then you have a recipe for a deal. But there's no hard and fast rules to say, hey, you need this many years or this much age to be able to attract institutional capital. But I think it's nuanced to say, what is your overall experience and what's your capacity? I think also it helped that we were investing in a deal in our own backyard, in our own market that we're also headquartered in. And that gave an additional level of comfort. This was capital coming out of the Northeast, and they're looking to allocate life insurance funds towards real estate and diversify capital across many different markets. They were not exposed to this market, but they also recognized that we were local, very hands-on, and I think that also helped. Those are a few things, but I don't think there's any real rule. There are institutions, though, however, that say, like, for example, we require you to be vertically integrated, for you to have your own property management, construction management firm within your company. We require a certain amount of full cycle transactions. So it just depends. But I think that there's no hard and fast rule to answer your question more simply.
Gotcha. Okay, good to know. We had one of our community members recently close on a deal where, in this particular deal, there were 2 times when institutions said, yes, we'll invest in the deal. And then last minute, they want to change the terms drastically. And he was lucky enough to be able to get out of that and still be able to get the seller to extend the closing and be able to raise. He ended up raising all retail money, but same deal to have 2 two institutional players play that kind of game. Is that a very common thing in that marketplace? And have you ever had challenges like that?
We have not run into it. I guess I've heard others potentially run into that kind of on the outlier sort of realm of the marketplace, but it's
Mhm.
not something that I typically hear a lot about. But I will say when we were working with our equity broker initially on this, as we were evaluating certain potential leads, there were a few groups that had an MO for doing things like this that we were alerted about
Mm.
ahead of time that we decided to not explore further conversations with as we were pursuing a partner there. I think there is, I mean, we all know even LP investors who make commitments that back out, and maybe that's a little bit of their MO. And I think that there are certain players in the market that have a little bit of an MO that they like to move things around when it's very inconvenient, to say it nicely.
Yeah, exactly. Talking about transactional relationship, right? Sure way to
Exactly.
Jeez. Besides speaking on stages, what are some and have your podcast, speaking on other people's podcasts, speaking on other stages? What are other channels of marketing that you have found worked really well in attracting new capital?
It's a good question. Email marketing is still king as far as I'm concerned, and it is about nurturing relationships. Really, our philosophy is much more long-minded than I think most. And so like when we bring
Mhm.
someone into our world, it's like, hey, we're talking about what we're up to, whether it's through social media, on stages, hosting events, attending other events, attending conferences, sponsoring conferences. Like we're making our platform known. And at that point, if someone decides to join our world and just observe, then we're just developing that relationship. So like our focus is adding value and giving expertise, talking about the market, talking about what we're seeing, being transparent about challenges that we're facing or things that we're encountering within the market, and just continue to add value with no expectation for anything in return. And over the long haul, that either leads to someone investing with us or someone saying, hey, you should be a part of their network, because not only they host events, but they have this great newsletter where they're sharing information and access on an ongoing basis. Like we do a few things. We actually do quarterly investor events. We just did an event in Las Vegas last month where we hosted a bunch of investors at the Aria Resort and Casino alongside the NMHC conference. In
Wow.
May, we're hosting people at the Kentucky Derby. We have a few like experiential type of things that we do that's really not focused on education, but it's focused on relationships. It's focused on just how much do you know us and trust us and like us and all this kind of stuff, and how much value can we add to you? What is it that you're looking to accomplish? So it is like a few pronged approach, but those are some of the things that we've been doing that have been working. But I do think that ultimately people are really starving and really looking for relationships, and that's what we try to provide.
Right. Yep. In this world of AI, right? Like relationships become even more important.
That's right.
Talking about, yeah. So, what are some of your favorite tools that you use in your business?
Man, we really like HubSpot. It's a great tool. It allows us to really amplify our message, stay on track in terms of relationships that we're developing. And it's a great CRM, but also a great marketing tool. We also we've become fond of Agora as an investor portal. That's been a great portal for us. It allows folks to track their distributions, track their accrued returns if there's any partial distributions and so forth, and beyond sort of those factors. But that's been a great tool for us. Man, as simple as it sounds, DocuSign is a great tool for us. Google Meet is something that we use a lot. We do Zoom as well, but our whole business is built on Google. And we have folks that work in our office here, but also remotely in other markets. And Google Meet has been a great way for us to all collaborate. But just the Google Suite in general, Google Drive, Google Docs for investor communications. Like we're very passionate about sending robust investor communications. And this allows our asset management team, our property management team, and investor relations team to collaborate on data and so forth so that we're being robust and transparent. But beyond that, we actually use a platform called Basecamp for project management, and we've been really passionate about that over the past few years. A lot of people use Asana. Basecamp is very similar, but it's been a great tool for us to stay on track for projects and so forth. So those are just a few.
Very good. Thank you for that. Yeah, it's a good list. All right. I'm curious of your crystal ball here in 2025, especially with this new administration. What are you seeing on the horizon? Yeah, for especially for this multifamily market that we're in.
I love it. Yeah, let me get my crystal ball out, and it's very valuable, and no one else has it. No, but it's interesting. We still see a lot of volatility from a capital markets perspective. Earlier today, I saw interest rates, treasuries were down by like 10 basis points, which was encouraging, and we've seen a little bit of a trend potentially begin to build over the last week. So that's encouraging and happy to see that. But I think it's interesting to look back, like 2024, a lot of the sentiment, I think, from smart money was, hey, 2024 is going to be this, there's going to be a tremendous amount of opportunities second half of the year. You got this wall of maturities. And ultimately, that didn't really come to bear to a large degree because most lenders were in open dialogue with borrowers and working things out and kicking the can down the road, so to speak. And I think the sentiment is very similar today that it was in 2024, that the second half of the year, you're going to see a tremendous amount of deal volume as a result of maturities and this wave of maturities, and maybe lenders are getting a little exhausted with the process. And so that's going to force transactions because at least in our markets over the last few quarters, that narrow between seller and buyer expectations has been from here to a little bit closer to here. So I feel like we're probably still 5 to 8% off in terms of like seller expectations, buyer expectations. And I can say, like, for example, we have a couple deals that we'd love to sell this year that we're refinancing and holding longer because if we were to sell at today's market pricing, it just wouldn't meet expectations. And we're not interested in doing that. And I think that's the case across the board. So transaction volume still is very low. I expect it to stay somewhat muted here, but it'll be interesting to see whether or not mid-year there's a forced level of market participation. But I do feel like the last couple of years for the deals that have worked, which have been fewer and far between, the deals that have worked and made sense and where you have motivation, like some of those deals have been some of the best deals that I think that we've done since our inception. And I feel like we're continuing to be in this window of opportunity. You have inflation that continues. You have challenges perhaps in consumer confidence. So you have a couple of different conflicting issues in terms of the capital markets that are impacting the Fed's decision-making as well as the treasuries. And it would be interesting to see if we can see more stability in the capital markets. Who knows? I don't have a crystal ball that can tell me whether or not we're going to see more stability here. The other thing that's coming into play is, will the federal government actually get the deficit under control, which is a big factor in terms of inflation. There's definitely been some big moves over the last month when it comes to cutting some fraud, waste, and abuse from the federal government. So it'll be interesting to see how that plays out and is actually impactful in the market. But ultimately, I think it's all like it depends kind of scenario. And I don't think lenders are in the business of owning real estate. And I think that will continue. I think that there will be pockets of distress and opportunity, but my guess is that it's not going to be like widespread and back up the truck and you're going to be picking up assets for pennies on the dollar. That's my guess.
Yep. And also hopefully they'll get the 100% bonus depreciation. They'll renew that as well. That'll be amazing. That'll help with our capital raising for sure.
Yes, it will.
Yeah. Very cool. All right, Tyler, we're going to open up for Q&A here in just a little bit. Before we do that, for those that wants to reach out to you, perhaps invest with you, or other ways to learn from you, partner with you, where would you like to send them?
We just launched a brand new website. It is cfcapllc.com. Again, that's cfcapllc.com. So definitely recommend folks check that out, learn more about us, what we're up to. We definitely have a tremendous amount of market intel materials that are all free. So please go there and grab them and engage with us and build a long-term transformational relationship with us. That's what we're in the business of. I always say, like, real estate is our widget, but our real value is in developing long-term relationships. So we certainly welcome that. You can find me there. I'm also active across social media on X at the Tyler Chesser, on LinkedIn as well, and Instagram and Facebook to a lesser degree, to be honest with you, but still active there. So yeah, the best place to find me though is at cfcapllc.com.
Very cool. Thank you, Tyler.